Today's class, ladies and gentlemen, capital markets and public companies. This is the second most popular way to lose your money. The first most popular way to lose your money is to have kids. Guarantees financial disaster for a significant period to come. But if you can't wait, to have kids and you want to lose your money straight away, then the stock market might be good for you. We're going to discuss a little bit about what capital markets are, how they operate, the main features, and then the main features of public companies and the regulatory framework that goes along with it. So this gives you, as I said, like a broad overview of what's going on. We need to have an appreciation of what's happening, but we don't need an absolute in-depth knowledge of all the legal instruments here, because this is a lot of stuff. You'll be told that securities markets in general, right, are the most important components of a modern economy. And why are the most important components of a modern economy, apart from the fact that they lose you money? They are assumed to be the most efficient way to use resources. And how is this resource allocation supposed to happen? A marketplace, a big marketplace, like a stock market, like, these capital markets, they're meeting places between people who've got excess funds and people who have a shortage of funds. So the people with the excess funds use these mechanisms in order to bring their money to the hands of the people who've got the ideas but they like the money. So that way, supposedly a productive economy is created where the people with the entrepreneurs, supposedly the people with the great ideas, they match the funding with those ideas, they manage to engage in productive capacity, do great stuff. The people who gave them the money make a nice profit, and the whole world goes around, and all this beautiful. But of course, for all this beautiful system to operate, it needs, say, us, on the fringes of the system, we say that it needs a little bit of regulation. Now, if you talk to George Osborne and his friends at the Institute of Economic Affairs, they're probably going to tell you that the whole thing could just run magically on its own without any government whatsoever, and that you don't need any regulation and rules and all that stuff. However, the rest of humanity tends to think that a little bit of regulation to make these things more predictable and secure is a more appropriate arrangement. If we're talking about capital markets in general, and we're talking about the principal actors in these capital markets, who are the people there? We said about the people who've got the money and the people who need the money. So who exactly are we talking about? Banks, financial institutions that might not necessarily be banks, but they've got common elements in their behavior as banks, corporations, obviously, government agencies. We have seen that stock markets, in particular, for public listed companies, are an excellent way for the company to generate money. And how does a company generate money by listing on the stock market? If the company divides up its shares and registers as a public company and then enters the stock market and offers these shares to the wider public, it has a long pool of people from which it can draw money. So it decides the amount at which to sell its shares, and then as members of the public are purchasing those shares, then it generates a lot of money. And what does the company do with all that money that it suddenly came out of nothing, right? It uses that money to reinvest and grow and do various nice things. And a market, you could argue that this could happen without the market, right? You could just have a public company. It has the capacity to offer the shares to the public. You don't need to do it through a regulated stock exchange, so then why have the stock exchange? The stock exchange makes it easier for buyers and sellers to find the appropriate prices. So the stock market offers you this mechanism that this exchange can take place. It makes this exchange more secure and predictable, and also makes price discovery a lot easier. Because you can find in the stock market similar corporations, you can get a whole lot of information that helps you assess both whether this particular company you're interested in is a good investment proposition, and also helps you position this against everything else. So you want to invest, say, in an energy company. Which energy company should you pick? Doing this through the stock market gives you tools and information in ways that are much superior to investing companies outside such a structured mechanism. One basic interest in the stock markets, in established meeting points such as stock markets, is that they increase liquidity. By liquidity we mean the availability and the movement of money, right? If you got a regulated exchange, that all these happen in a sort of organized manner, then more people are willing to engage in transactions faster. And the volume of transaction is significant for the health of an economy and the ability of businesses to raise money. So the volume and the speed of transaction is as significant as the amount of money involved. When you read in the financial press, has it been a good or a bad day in the stock market, they will tell you not only has the index gone up or down, but they will also tell you the volume of trading, right? The higher the volume of trading, the more significant the day it's been in the stock market. If you're thinking about the ways that the companies are raised, we've already talked about the idea of a company floating, as we say, in the stock market and making its shares available to the wider public to purchase, right? This is equity investment. When in the financial press and in the relevant textbooks they talk about shares in companies, they talk about them as equity securities, right? This is the normal stuff of company law. But there's another aspect to the money raising thing, and this is the debt market. So we're talking about debt securities. And this is also very significant, and this is also traded in exchanges, not stock markets. Stock markets are for the shares, but there are other exchanges that deal with debt securities. The debt securities are loans or IOUs. A company could raise money by saying, I split up myself in shares and I'm making these shares available for people to buy, and when they buy these shares I get the money. So people get an ownership stake in this enterprise. Or alternatively, they could say, I am selling this piece of paper that says, you give me £1,000 now, I give you £1,100 in a year's time. Here's a corporate bond. By purchasing a corporate bond, it's opening some sort of savings account at the bank, or buying an investment product at the bank, or buying a bond at the bank. But it's not only banks that can do this. Any entity can do this, and corporate bonds are the way that the companies raise money through this. So you buy something that says General Motors, it's worth £1,000 today, it's worth £1,100 in a year's time. And that debt, that loan, that instrument is also a negotiable instrument, as you've seen in various contexts, and there is an exchange where this can change hands. But debt security does not give you an ownership claim in the business. If the business goes bust, in a way, if you're a shareholder, you have a part of it. If the business goes bust and you have an IOU or you got a corporate bond, then the corporate bond might not be repaid and there's absolutely nothing to it. So this is how this links with our discussion that we had on insolvency in the previous class. So try and keep these two separate, right? When they talk about equity investments and when they talk about debt securities, it's different types of participation in a company. A discussion of stock markets inevitably brings us back to a consideration of the nature of a share. What exactly is a share? And we've discussed this in the past when we were trying to figure out, should the share be understood as a property law-based right, or should it be understood as a financial right, and what are the implications of one versus the other? You remember that when we were talking about minority shareholder protection, especially in the context of unfair prejudice, we said that the court will try to protect the rights of the minority, primarily viewing them as financial rights. That's why a common remedy for unfair prejudice is an exit right? They buy your shares and you get out. So it's your financial investment that's considered to be very important, as opposed to your participation in the company as a property owner, which would have you remaining in the company, right? It wouldn't, in that case, if you took that view that property right is more important, then giving you an exit right as a response to unfair prejudice sounds a little bit peculiar. The law here is not particularly consistent, because in certain areas, as in unfair prejudice, the courts are placing emphasis on the financial value of the share. In other cases, they're placing emphasis on shares as property rights. This has an important contemporary illustration in the court battles that you've had after the financial collapse in 2008. If you look at the cases around AIG, the big insurance company, and Hank Greenberg, who was the chair of the company at the time, you're going to see that this debate as to what is a share and what value does it represent has become a very significant problem in the States. Because what happened there is that AIG went and the government bailed it out. And the government bailed it out through a series of mechanisms, but it took control of significant amounts of shares in a forceful manner. So they saved them, and there was a debt equity swap when, the people that are owed the money exchanged them for the shares. The original owners of AIG, despite being thankful for having the company saved, because, if Hank was so great, how come AIG ended up in such a mess? And he had to be bailed out by the government? Well, you'd think they'd be grateful, but they weren't. Because they said that the price of the shares during that exchange was not fair. And the government undervalued the company. So the government's view of what the company was worth when the intervention happened did not reflect the actual value of the shares. So they've gone to court, and this thing is raging through the courts, and you got some decisions on it at the moment. It doesn't look like Hank is winning the argument here, but this is complicated, and there are a lot of cases along those lines for the majority of corporations that were bailed out during the crisis. So you got similar arguments not only for financial corporations, you got similar for the auto industry, for a number of places. So what does English law tell us about the value of the shares and how shares are perceived? An interesting case to look at is the case of Short versus Treasury Commissioners. It's an old case from 1948. The question here was, at the point of winding up, how do you know what the shares are worth? If the company is getting dissolved, should we say that the company is worth X amount of money, I've got Y amount of shares, so I just divide the total value of the assets by the number of shares, and I know how much each share is worth. Do I do this, or do I take the stock market value of the share? The stock market value of the share has got nothing to do with the actual value of the company, right? The stock market value of the share is what people think the share is worth, which to what the value of the company is, but you have very significant variations a lot of the time. So everybody thinks that Apple is so great, right? So Apple at the moment, it has like the most expensive share, I think, in the world of all the shares that are publicly traded, because people think it's so great. It could be that tomorrow they discover like a massive fault in the software that causes everybody to panic, and then the share drops by half. 2005, 2006, the shares in the Greek National Bank, there was something like, 15, 17, 18 euros a share. You know how much they're worth now? Like 2 cents, 3 cents. Okay, of course, the asset base of the company is significantly more impaired now than it was back then, but you can have huge differences in the valuation. And that's why all this seems a little bit like, smokes and mirrors stuff. That they all say, oh, the market capitalization of our firm is, it's like $6 billion. Because everybody thinks we're great. And the next day everybody thinks we're not great, so our market capitalization now is half what it used to be. So we've lost $3 billion. No, you didn't lose them. You didn't have them to begin with. It's just that people thought that this is what each share is worth. Now everybody thinks the share is actually worth less. All this is a bit of a fiction. So to base your perception of the reality of the financial position of a firm on its market capitalization idea. Goes up, goes down, goes up, goes down. Yeah, this is what the index represents. When they say that the stock market index has gone up or down, it tells you something about people's perceptions about the value of the companies, the value of the economy, but this is not real money. And this doesn't have till you sell the shares, it's not real money. I could think that this computer here is worth £1,000. Is it worth £1,000? Till I find somebody that's willing to buy it at £1,000, it's not worth £1,000. No. Be a little bit skeptical with the value of shares and market capitalization. But at the winding up stage, we do have an issue because we need to make a decision as to what the shares are. Are they a percentage of the assets in total of the company, or are they what the stock market says they are, or it said before they came out, or are they something else entirely? The argument here in short was about taxes, obviously, because they wanted to tax the company based on the value of the shares. The court said that the shareholders are not, in the eye of the law, part owners of the undertaking, and they're not entitled to have their shares valued by the method of apportioning what the undertaking is worth. So there is no direct relationship between what the whole company is worth and what the shares are worth. It is a better way to assess what the shares are worth to look at the stock market price, but even the stock market price on its own. So what do we have? The stock exchange quotation is the best evidence of value, but it doesn't determine the court's impression of what the number should be. So it is subject to other evidence, and is subject to another discussion. So you might have an ultimate value of the shares at winding up that is between what the company is worth divided by the number of shares and what the stock market valuation of the whole shares was. We have to think about shares and the valuation of shares in a more dynamic way. Our most accurate, perhaps, if you look at the case law, our most accurate predictor of the value is what the stock market says, but this is not immune to challenge. Right? If you want more information on this, have a look at the case of Short, and then have a look at the current cases that emerged out of the crisis. How you get into these bitter fights about share valuations, either because the revenue is challenging the valuation for tax purposes, or because people are challenging the valuation in terms of takeovers or emergency measures by the government and so on. Now let's move on to the idea of stock markets. Do you have only one stock exchange? No, you can have multiple stock exchanges, right? Nobody says that you only can have one exchange per country. Actually, nobody says that the company can be listed in a single exchange. They could make their share available in a number of exchanges. And supposedly, this is another impression of market theory and competition in operation. You've got exchanges competing with each other in attracting the best companies. Right? So you get some of those big Chinese companies that want to float some shares in the stock market, and there's this debate: are they going to go to Frankfurt? Are they going to come to London? Are they going to go to Hong Kong? Are they going to go to New York? Where are they going to go? And where they decide to go, somewhere some rich people are happy about it. And now, what markets do we have in the UK at the moment? The main one, of course, is the London Stock Exchange. The London Stock Exchange operates two markets simultaneously. One is the main market, but you also got AIM, which is the alternative investment market. The AIM is for less well-established companies, more entrepreneurial stuff, riskier investments, one might say, right? But these are two stock exchanges that are operating under the same umbrella. You also have others, because there's no monopoly, as I said, in the stock exchange. You used to have something that was called Plus Markets PLC, was a corporation that ran a series of smaller exchanges, specific industries. It went bust. It got bought by some other guys. It has become less significant since. So the main thing to keep in mind for you guys is the London Stock Exchange in its two impressions: one, the main market, and AIM, the alternative investment market. What is this FTSE? This is just an exchange index, right? It doesn't have like a statutory impression or anything like this. FTSE stands for Financial Times Stock exchange. It's an index. It was originally developed by the Financial Times newspaper. It is basically a collection, a series of collections of different companies on, certain characteristics. And if you look at how the companies within that index behave, it tells you something about the overall operation of the stock market. So you've got, for instance, the FTSE 100, because this is the 100 largest companies by market capitalization, which means market value, right? So this, as I said, was a snapshot of the companies with the highest capitalization. People come in and out of this list as companies' prices change. You've got other, you've got the FTSE 500 as well, that includes more companies. You've got similar stock price indexes like Dow Jones, S&P, Nasdaq. You all hear about those in the news, that you see some rich people being happy for something or being unhappy for something. Nobody knows what it is. What is the distinction between primary and secondary markets? Because you will hear this as well and people are wondering what it is. When a company decides to raise funds from the public, they issue new shares, right? Or they could issue new debt securities, as I said, bonds and stuff. The first time something is created, we're talking about the primary market. This is when the company itself sells either its shares or its bonds to the public. So from the company to the public. This is the primary market. The secondary market is where people are selling to each other. Because all these are tradable instruments, freely exchangeable in a stock market. Pay attention to this because it has to do with the money. When, say, a company launches shares, it can put a price on its shares. This is its initial offering. So it could be that I split up my shares in 1,000 shares and each share is worth £10. And I make this available to the stock market. People buy them. I made £10 per share. So I get all this cash to use it something. However, then this price changes as people are starting to sell to each other. They don't sell back to me. I don't have additional shares to sell, but people are selling to each other. And something that originally sold at £10, it could end up being £50, 100, 200. You remember what happened with the post office? When the government privatized the post office, they made the shares available at a specific price, and immediately the price moved very widely. And because the price went significantly higher in the secondary market, everybody was unhappy and they said, the government could have sold originally at a higher price and generate more money for the post office. I said at the very beginning that all this looks like a fantastic mechanism for providing liquidity, offering a meeting place between buyer and seller, creating all this great stuff. There's gotta be something cool in it because, there are all these people wearing nice suits, right? So there must be a benefit in having all that stuff. However, for the rest of us that hardly ever see any benefit out of all that stuff, we think that some bit of regulation might be necessary so the boys in the Cayennes don't go completely crazy and destroy the world like they did in 2008. So what are the aims of regulation of a market system? It is said that you need sound and effective regulation to ensure the integrity, growth and development of securities markets. So the aim of regulation is to protect the investors, ensure that markets are fair, efficient and transparent, and also ensure that the failure of particular corporations does not have systemic consequences. So you need all this regulation to make sure that you're not taken advantage of, that people don't do deals with each other and they all know each other and they've given inside information one to the other and they make a lot of money while you're the idiot in the corner that ends up losing out. So this needs to be prevented. You need to have accurate, adequate information. How do you get this? There's got to be a law that obligates them to give you this information. And also there need to be some stop gaps so failure market do not create a domino effect that sort of wipes everything out. Not that this works, of course, because, it did wipe everything out in 2008, but, theoretically. If you're thinking about a regulatory legal framework, there are some minimum stuff that it should contain. So you need, for instance, an obligation on the people who issue securities to disclose all the relevant information so that the investors can make an informed decision, and that there are rules to ensure that they continue to supply correct information regularly. You need an obligation that all investors are treated equally and fairly. And you have an obligation on financial intermediaries to be organized and operate in ways that ensures the safety and robustness of the market. You also need the rules to prevent manipulation and unfair trading practices. So you need all that. You need it in the law, and you need to have specific sanctions if this is not done properly. Now, what has happened here is that we have a little bit of a change in the regulatory system since the crisis. So it used to be the FSA who was responsible for all this protection of the investor and having out standards and so on. There was the UKLA that dealt with in the London Stock Exchange, and all this was regulated by the Financial Services and Markets Act of 2000. Now we have the ex-Financial Services Authority. Strange thing is that the UK had a unitary regulator model, meaning that you had one big regulator for everything. Other countries had multiple regulators for different types of markets and different aspects of the markets. When the whole thing came crashing down, everybody else in the world thought that this compartment-style regulation by various bodies in various places clearly doesn't work, because nobody has a clue what's going on, and we should have a single regulator. Us in the UK that did have the single regulator, we thought, oh, single regulator doesn't work, we should split it up and have a whole bunch of agencies. Does it make any sense? No, it doesn't. It probably suggests that there's something more significantly wrong about the whole structure of the system, but there you go. The rest of the planet has moved towards single regulators. The UK has moved away from single regulators. Now, a little bit of information on the FSA. As it used to be, its tasks was protect the stability of the financial system, deal with consumer protection, and combat financial crime. And also they had some sort of systemic stability things. And they produced a detailed handbook that was arranged around a series of principles. And why principles? Because this was the high sort of tide of principles-based regulation. Meaning that instead of forcing people to do stuff, we don't tell them how to do it, we tell them what the outcome should be, what they aspire to, and then the corporates themselves work towards that aspiration. Principles, right? You tell them where they want to be, not how to get there. Of course, all this worked spectacularly well, right? And it all came crashing down. There was a brief period of time where we thought, maybe principles-based regulation is not a great idea, we should have. This lasted for about 6 months, and then they went back to principles-based regulation. The problems caused by people like the ex-Sir Goodwin of RBS and all of that meant that we needed a new act to implement the new changes in the regulatory framework. We ended up with the Financial Services Act of 2012. Now this changes the whole system. We still have to make reference to the 2000 Act, but there are a lot of places where changes have been made. And this has amended parts of the Bank of England Act, the Financial Services and Markets Act, the Banking Act, all sorts of stuff. What is the new regulatory framework? The best way to present this, I guess, is to focus on what is the replacement for the FSA. The FSA, part of its power has gone to what we call now the Financial Conduct Authority. This is the listing authority. It has to do with the listing authority. It has to do with the stock market. It's charged with ensuring that markets function properly, consumer protection, integrity of financial system, promoting competition between financial services providers, This is what the FCA does. The Financial Conduct Authority is the close. But we've also got parts of the previous role of the FSA going to something that's called the FPC, the Financial Policy Committee. This is part of the Bank of England. The idea is to maintain a close eye on systemic risks to the whole of the financial system. Part of this of the role of the FSA has gone out to the Bank of England. Is responsible for recognizing investment exchanges as a whole, now the Bank of England. And you've also got now the Prudential Regulation Authority. The Prudential Regulation Authority is a subsidiary of the Bank of England, and it has to do with the supervision of banks, building societies, insurers. The aim again is the protection of the financial system. So for the purposes of this class that deals with capital markets, the most important one is the Financial Conduct Authority. It's taken over the website of the FSA, and most of you might find in your notes on something that said FSA before. Now it links directly to the FCA website. So we're not to become experts on various aspects of financial supervision, but we need to be aware that now there's a system that has replaced the FSA, and when we're looking for information for the listing rules, market particulars, all of that stuff, we need to look at a different body and not keep referencing back to the FSA. Some of the most important stuff that have to do with listing in the stock market are rules as to what do you do in offering the shares, and how do you put together a prospectus, and what sort of information do you put in your prospectus. As I said, not all public traded companies are in the stock market, so there's a difference between traded shares and shares listed in the stock market. Forget this. But if you are in the stock market, the first time that you need to issue your shares, the sort of primary market activity that I mentioned before, there's a lot of information that needs to come with this IPO. Have you heard about IPOs, initial public offers? Right? There's usually a lot of big corporation decides to do this. Alibaba, the Chinese one, was a recent one that did like an initial public offer. That was very interesting. Now, an IPO is normally an offer of sale of the shares to the public. It is done normally through a bank intermediary or a financial institution that acts as a promoter for those shares. And it needs to come with a prospectus or a set of listing particulars that contain, according to Section 80 of the Financial Services and Markets Act of 2000, all information as investors and their professional advisors would reasonably require and reasonably expected to find for the purpose of making an informed assessment of the assets and liabilities, financial position, profit and losses, and prospects of the issuer of the securities, and also the rights attached to these securities. So this is at an initial stage when somebody is offering shares, the prospectus that comes with them has a very significant set of data that need to go to the public. So all of this comes, if you look at the listing rules for the stock market, it will tell you what you need to have. These were issued by the UKLA before. Now the UKLA, the listing authority, works as part of the FCA, as I told you. What happens if within all those listing particulars there are stuff that are wrong, right? Because we said if you need to have all this information in your prospectus in order to give people an accurate impression of the company and the shares and what it does, what happens if something goes wrong? What happens if you put the wrong information in there? It misleads the public, they make the wrong investment decisions. There is liability for misstatements in the prospectus or the listing particulars, right? And of course there needs to be some liability in it, otherwise it defeats the purpose of having like a regulated system where there is an element of investor protection. So if there are mistakes within this, then you can have liability to compensate people who have suffered loss. There are administrative can be imposed by the regulator, and there's also criminal liability. These have been rising. You get some references in your lecture notes as to fines and so on. The FSA at its end days became a lot more active in pursuing people for mistakes in these things and increasing the amount of fines it gives. And now you got more and more high-profile cases where they go after corporates for mistakes in the particulars. It's an attempt to sort of tighten the system. And also to show that even though the FSA and the regulators were asleep at the wheel in 2008, now they're a little bit more active. Now, what about compensation? We said that compensation can go to anybody who has suffered loss after obtaining securities as a result of misleading or omitted information. This right of compensation is not limited to the primary purchaser of the share, but it also extends to people who purchased shares in the secondary of the Financial Services and Markets Act of 2000 for details exactly on how this compensation is assessed and what it covers. Now, the criminal liability arises when you've got a statement that is materially false or misleading. It could be made knowingly or recklessly or dishonestly. So there's a wide range of criminal liability that comes with these things. You need to remember the basic structure of the markets. What markets are there? What purpose do they serve? You need to have an appreciation of the functions of regulation. Why do these need to be regulated and what happens if they don't? And then to have a basic appreciation of the operation of the stock market, at least in this jurisdiction, what sort of stock markets you have, what they do, and then where are the rules and the regulators to get them in. So we don't look into a great detail in the listing particulars themselves, but we need to know who manages the system.